welcome you to IDEA IPO, How to Prepare Your Startup for Venture Capital Investment Part 2. My name is Roger Royce. I'm a partner with Haynes Boone in Palo Alto, California. And what I'm going to do is I'm going to go ahead and give you a presentation with the slideshow for about an hour. We'll go to the top of the hour and then we'll open it up to Q&A. For those of you who were here last month, you saw part 1 where we set the stage for Venture Capital Investment Part 2. And today we're going to get into more terms of venture capital investment. So let me share the screen. And what I'd like you to do is to all right, you should be seeing my screen. So somebody could chat me and just let me know that the screen is set up. And just so everybody knows, this was set up before we started. My camera failed 2 minutes before we went live. But that happens sometimes. Sometimes it doesn't. And sometimes we just have to roll with it. And we're going to roll with it today. So you're not going to see me live, you're going to see my slides. So again, if you were with us last, you heard all about how to get teed up for venture capital. Today, we're going to talk more about the exact terms that you might run into. And where we left off last week had to do with safes and convertible notes. This is a slide that we were on. And you may recall that I was talking about how a lot of times when money goes into, and this is going to be important in venture capital, by the way, because those safes and notes are going to convert into preferred stock in that round. And you may recall that we talked about how money goes into safes and notes and at some point converts. Now, the money that comes in, it comes in on a convertible note as a debt. So it has to be repaid with interest. And if it's not repaid, it'll convert. Okay, that's the idea. But the difference between a note and a safe, you recall, is that a note pays interest, a safe does not pay interest. The note has to be repaid, a safe doesn't have to be repaid. If there's no exit, there's no liquidation, or if there's no conversion. So we had talked all about this. This is just more of a refresher because I want to dive a little deeper on this now. You may also recall that there are 2 very important features of both notes and safes. Is that when the note comes in, because the money is going in early, when it converts, it's going to convert as a discount. In other words, every dollar or every 80 cents that you put in, if you have a 20% discount, that usually means that you are paying 80% of the preferred stock price, right? So every 80 cents you put into your note is going to convert into $1 worth of preferred stock when the company later are set up. The valuation cap is the idea that there's going to be a maximum valuation at which the note is convert. So in other words, let's suppose that somebody invests in the company when it's worth a couple $1 million and somewhere down the road, I'm sorry about the pinging noise. There's not much I can do about that. So you get into the company when the valuation is really low and the valuation goes really high. Well, you want to get in at something was when you invested. So we put a valuation cap on the company. Let me try something, see if this gets rid of the pinging. Let me know if that helped. Okay, that seems to help. There we go. So that's the valuation cap. Now, oftentimes that valuation cap, people don't want to set that at exactly the value of the company. It's really intended to act as a governor, right? In other words, it's just something that avoids you from having a runaway valuation, which sometimes happens. In other words, the company uses the investor's money to run the value way, way up. And that's what valuation cap will usually be, just something that adds a little bit of protection, but isn't exactly a proxy for today's valuation. Couple other terms we talked about. There'll be what they call a most favored nations clause sometimes. And what that means is that if somebody buys a note or a safe after the transaction, that note or safe is going to convert. The note that was sold in an earlier transaction gets whatever the more favorable terms are of the later note or safe. That's the most favored nation clause. You're not going to give anybody else a better deal, or if you do, you'll get the benefit of that deal. And then what I really want to focus on are some of the other terms like pre and post money. So as we said, convertible debt tends to be short-term, rarely secured. Most companies don't have much that can secure it. They have to pay interest. They have to have a fixed repayment date. We talked about discounts and valuation caps. Now, safe. And a safe is like a note with no interest requirement and no fixed obligation to repay. Now, I want to talk about two things about safes. One are the pre and post money. And the second thing is the idea of a pro rata right. So let's talk about the pre and post money. So remember how we talked about the valuation cap. Does this cap? So let's say that we have, here's a simple example of what I mean by pre-money. Currently valued at $4 million. Company sells $1 million safe. If you have a $4 million pre-money valuation cap, well, that means the safe gets 20%. 1 million divided by 5 million. That's the 4 million previous valuation plus another million, right? Pretty simple. Post-money valuation cap means that that 4 million is the valuation after you take the investment. $1 million safe would get 25%, not 20%. So that's the difference between pre and post money. Now that sounds pretty simple, but it can have really large consequences in the real world. So that's what we really want to watch out for. And generally, if I'm representing a company, I will fight really hard for the pre-money valuation cap because just because of the amount of dilution. There's a lot less dilution to the founders in a pre-money scenario than a post-money scenario, right? The investors oftentimes will argue for the post-money. The reason they do that, they will tell you, is because they want to know what percent of the company they're going to have. That no, you have some, you've been diluted. You have a way smaller percentages company than you thought you were going to get. Now, there's a place for both of these kind of safes, depending on the financing. And these probably used to be a lot more prevalent back during the days when safes were intended to be pretty short term. In fact, before there were safes, like I said, there were convertible notes. Before that, there were bridge notes. Financings, they were intended to be very short term, and you expected that convertible would convert without a lot of other money coming into the company. If that's your case, if you have one big safe that you expect to convert without a lot of other safes coming in, then a post money is not going to make that big a deal. On the other hand, if you're like most companies I see these days who use safes as their substitute for other sorts of financing, then the pre-money valuation can really hurt the company. Diluted in a pre-money scenario, the safes take the dilution of the other safes. In other words, the post-money can really hurt the company because in the pre-money, the safes take the dilution of the other safes. And in the post-money, the safes do not dilute for the other safes. So that's the difference between these two types. And that's what we really have to think about here. And that's why companies generally are going to prefer a pre-money safe that's company favorable, that's investor favorable, something to keep in mind. So moving along, other than safes, there's other ways that early stage companies can take money in. One is through what we call series seed stock. And series seed stock is preferred stock. It's what we call a priced round, but it's very watered down. Okay, it's a preferred stock. And watered down, what I mean by that is it doesn't have a lot of the bells and whistles that the VCs will fight for really hard. You're never going to see redemption rights. You're never going to see, you'll usually not see registration rights. You probably won't see, a big battle over board seats. Just fairly minimal rights. And it sort of makes sense in the early stage because number one, the investor is getting in at the early valuation. We don't have to worry about guessing on, we don't have to worry about a valuation cap because they're getting in at a lower early valuation. And secondly, in your later round stock, your series seed stock, terms are going to get renegotiated anyway in the sense that the series seed is going to tag along with whatever the next round has. Now, why do people do this? Why is it safe to preferred stock? Why not just sell common stock in a financing? And if there's one thing you learn here today, it's that common stock should never be sold to raise money. You should always sell preferred stock to raise money. And the reason why is that you want a low common stock price because you want a price low so that your options are attractive to service providers. And you want your common stock price low because you're going to sell that to service providers. And the way we justify that differential is by having, for the rest of this presentation, what preferred stock means. But for now, just know that preferred stock is always more than the common because of the preferences and the other rates that we're going to discuss. So that justifies the difference in price. The other thing to keep in mind is that the company wants to sell preferred stock because it's higher priced and it gives up less of the company. In other words, it gets more per share. They get more bang for their buck. The investors want preferred stock because they want all those rights and preferences. So this is how it's always done. Never sell common to raise money. All right. Let's jump right into terms here. I guess before we jump right into terms, it's probably worth, just talking about the terms that I'm going to show you. They're going to be tough, right? They're venture capital terms. It's really expensive money. You should always keep that in mind. And we talked last candidate for venture capital, right? You have to have a certain set of metrics, and you would not take venture capital unless you actually you absolutely fit those metrics. And that's where we are today. So, okay, let's move right along. First of all, if you take venture capital, you have to give up equity. This is not debt. Equity is expensive if your company does well. You may recall we talked a little bit about this. You would do this if you're not the kind of company that has near-term cash flow instruments, which is a lot cheaper than giving up equity. Venture capital is risky. That's why it gets a high return. It's illiquid. It's going to be a transactions, and it really has to be for a business that can scale. And by scale, I mean that can really grow and can grow into a huge market. So we're going to pause a little bit before we get to the terms and talk maybe about which VCs, because we didn't talk about this last week, which VCs you should approach. And there are different ways you can basically categorize VCs. The way I would think about it, just you can use all of these different categories. Are they thematic? Are they domain investors? Are they quant investors? But people investors, you might think of, of Draper as somebody who likes to bet on the people. You might think of other VCs as the ones that bet on the technology. So whatever it is, just make sure you and basically sell to your audience, I think is the best approach. And that's really important. Don't waste the time of people who really don't want to, who aren't really in your space. Now, here's something you really got to understand a little bit about venture capital economics to understand what the venture capitalist is looking for when you go to approach them, because that's why these terms are going to be so tough. So first of all, they're going to, typical VC terms are what we call a 220 formula. Sometimes it's 2.5, say 2 or 2.5. And what I mean by that is that there's usually a 2 to 2.5% management fee on committed capital. So that's every year they receive from their investors 2 to 2.5% of the money that's committed, not even called, but committed. Secondly, there's what we call the carried interest, 20%. That means the VC gets 20% of all the profit the investors have made, or that the VC has made. So if you think about that, that means that there's a lot of money going out the door before the venture capital funds investors really see anything. So they really have to have outsized returns in order to cover those numbers. Okay. And given the fact that LPs, if you just work through the math, trust me on this, because the limited partners in the venture capital fund need 2.5 to 3, the venture fund's going to have to earn 3 or 4 times its investment money in order to return that amount. All right, that's what they have to average. Not quite finished yet with venture capital economics. And a VC can just expect in their fund, because these are high risk investments, that half are going to lose money, 20 to 30 are going to return maybe their investment or maybe twice their investment. And that means the rest of them, right, the last 20%, they have to be home runs, 10 to 100x. And that's what they're betting on. They're betting that in their portfolio, they can find that home run. Or the way that it was expressed in one book on this, written by VC, is that, look, if I get 100x return on one investment, I don't care what all the other ones do. That one makes the fund, makes my numbers for me. So that's what they're looking for. General fit. We had talked a little bit about this. We're looking for a large potential market. Doesn't have to be an actual market. We're looking, usually it's a first to market advantage. That's really attractive. VCs are looking for long-term scale over short-term profits. Keep that in mind. They're really looking for that big capital exit down the road. They're not really looking for a lifestyle business that has a lot of short-term profits. It's typically a company that's not able to service its debt, and they definitely want to see something that has traction these days. I'm going to add one more category to this, because this has come up over the last couple of years, and that category is ESG. We talked about ESG last month, and I want to talk about it again, because it is a very important thing to keep in mind. That's environmental, social, and governance factors. Further down the economics, because this is going to inform the terms that we're going to discuss, is that the venture capitalist really needs to participate in management. That is the nature of venture capital investing, is that they take an active role in management. That typically means having a board seat, might mean being a board observer, which is somebody who sits in the boardroom during the meetings but doesn't have a vote. And if they don't have either of those, we'll do what we call a management rights letter, which is required for securities law purposes and or Investment Advisor Act purposes, which basically means that the VC has certain rights to management. They need it, they require it, it's part of the business model. Plan on the term of the venture fund to be 7 to 10 years. So when you're approaching the VC, it'd be really wise for you to do your diligence on the venture capitalist and figure out where they are in that term. Are they at the beginning of the term? Are they at the end of the term? Because if they're at the end of the term, they might be pushing you to exit before you might want to. So it's not likely you're going to get first money in while they're at the end of the term. They're probably doing follow-on investments at that point in more mature companies. And by the way, that's been happening a whole lot more over the last few years, where VCs are using their money for follow-on investments, not new investments. But keep that in mind. And the other thing you should keep in mind is because there's so much activity required of the venture capitalists, it's pretty hard for them to do small investments. There's only so many boards they can sit on. There's only so many board meetings they can go to. So because of that management burden, they really need to make fewer investments in larger amounts. That's why you wouldn't go to a VC until you really need the bigger money. Today we're talking about VCs. They're going to be looking for your team, your technology, your market size. This is stuff we all know. And by team, it's not only that you have a technical co-founder, which is a real plus, but that you have somebody on the team that has domain expertise. Pedigree doesn't hurt. They're looking for a technology or product that addresses a pain point, right? They want to invest in aspirin, not vitamin pills. Customer validation is great. And again, you have to have a possibility of becoming a big company. I know I say big market here, but what I really mean is that you can be a big company. All right. And almost any market can be a big market. There was a venture capital investment not that long ago, and believe it or not, a nail salon. Who would have ever thought that's a big market? But you'd be surprised. Almost any company can be a big company. So don't think the market is too small. Think how big the company could be. Now, when you pick a VC, just keep in mind that you really want to do your diligence on them as much as they're doing diligence on you. And the very first thing is reputation. Venture capitalists have reputations. Some are good, some not so much. It would be a really good idea to check that out. You can do that by Googling. You can do that by talking to companies they've invested in. It'd be really good for you to know how often they close. Are they likely to close? Or are they the kind of VC that they sign a term sheet and you can take that to the bank? Or do they just sign lots and lots of term sheets and don't really get the funding? I've dealt with both, and you want the ones that often close. Where are they in the fund? How big is the fund and how much dry powder? What I mean by that is that are they going to be able to support you in your follow-on rounds down the road? And if their fund can't do it, will their second fund formed by the same VC when they fully invest their first fund going to do that? It's a bad sign if the Series A investor won't invest in your Series B, if they won't participate. We'll talk about rights to maintain and pro rata rights, but you'd like to have a fund that's capable of doing that if you've got your choice. And then here's a big one. Are they litigious? If you've listened to me before, you've heard me say this before. I personally won't do business with litigious people. California, especially where I practice in Silicon Valley, it's just far too easy with anybody of $2,500 to go down to the courthouse and make your life miserable. So just make sure you're dealing with big boys who understand risk and understand that sometimes things work out and sometimes they don't. And this is easy. This is super easy to find out. You can go online. You can go onto the court websites, and it's all public information. You can find out if somebody sues their founders or gets sued by their companies a lot. If that happens, you might want to rethink how you approach that particular investor. It's a small valley, though word gets around. And then finally, make sure you're dealing with decision makers. It might take you a while to get to the decision makers, but just make sure, because VCs have a lot of different types of people that might talk to you. The people you want to deal with, the people that can make a decision. Entrepreneurial fit. I don't want to spend a lot of this time on this. You can go ahead and Google email from the CEO Circle Up, and you can see an example of a VC that did not fit the company, very publicly so. You definitely want to have VCs that really have the right temperament. They get along with the founders. It's super important. let's move ahead a little bit because I want to get to some of the terms. But types of funds that you might approach. Micro VCs, think of those as angels that are using other people's money. They make smaller investments. Seed stage funds, that's the early first institutional money in. Mid stage, it's Series B and beyond. And late stage, where you are in the process, depends where you might want to be. Typically, you get a lead or a co-lead, and then someone will follow. So you'll negotiate with one VC, even though there might be a lot of parties in the transaction. And then are these things called party rounds, which are the other way, where you basically have a lot of different VCs and you're, okay. If you have questions, by the way, I should have said this earlier, go ahead and put them in the Q&A box, and I'm going to get to that at the end of the formal presentation here. Just plan on there being a lot of people involved in the transaction. You're definitely going to need lawyers. I like to get a CPA just to make sure we're not going to have some, well, first of all, that our financials are secure and you can stand behind your numbers. And secondly, you won't have a tax result that you didn't expect. Sometimes there's finders or bankers or brokers, rarely in a venture deal. Rarely do you see that anymore. There's a time in this valley when you saw it more often. But there's so much money out there, and VCs are not hiding that you rarely need those. In private equity, it's different. You'll find bankers and brokers in private equity, but not in venture capital. And of course, mentors and advisors who might have brought you the venture deal to start with. Strategic venture is a little bit different. The question you would ask the strategic venture is this going to be good for the company? It's not just finance. It's because that there's some strategic advantage both for the investor and for you. For example, are they a major customer? Are they a potential acquirer? And usually that's how you get a strategic investor. They want a source of supply or they want to acquire the company. Strategic investors almost always want some sort of right to buy the company down the road. They'll ask for a right of first refusal, which means that they have before you can sell to anybody else, you have to offer the company to the strategic investor. You don't want to give that up because that basically means that you're never going to go out and offer to sell to anyone else because nobody else would do the due diligence necessary to buy the company if it's just going to get swooped out from under them. They'll sometimes ask for a right of first look, which just means you get them to look at it. That's what you really want to offer. Say, look, we'll tell you before we go out. You can take a look and decide. Or something a little more, I guess, with more teeth in it, a right of first offer, where you'll let them make the first offer before you'll take it out to market. So just keep that in mind. That's the big difference. One of the big difference with strategic venture. The other difference, and this is anecdotal more than anything, is I think you'll find them less engaged in management than a venture capitalist. Just been my experience. They tend to be less involved in the business. They might not show up for board meetings. You might not be able to get their attention. You're lost in some bureaucratic shuffle. Just keep that in mind because that can be significant when you're trying to get signatures and you can't get somebody to respond. Venture debt is just as it sounds. It's debt with some equity kickers. Usually we call it warrant coverage. It tends to be high priced, both in terms of the fees. The difference is venture debt is oftentimes secured by the company's intellectual property. That's why it's debt. Otherwise, no one would take that risk. And you'll probably suffer less dilution. We'll talk about venture debt some other time. I will tell you that VCs will almost always only invest in a C corporation. So let me back up one. Remember last month, we talked about the different types of companies you can form. You can form a limited liability company. If you do that, the VC is going to make you convert to a C corporation. All right, and that is a state law corporation, always under Delaware law, no matter where you're doing business, that is taxed as a separate standalone entity. And here are all the reasons why. I could go through all of these, but instead, let me focus on one really big one. And that's the idea of qualified small business stock. A lot of investors, individual investors, even those who hold through a partnership like a fund, can exclude up to $10 million of gain or 10 times their cost in an investment in a qualified small business. One of the requirements of a qualified small business is that it be a C corporation on the date of issuance of the shares that the investor has acquired. That's a big reason. It's a federal tax exemption. It's not a California thing, of course. California doesn't give you this break, but for federal law, it's still there. It almost halfway went away during this last round of federal legislation, but it did not. So it's still in the code for now. Let's just get right into some of the other things that VCs will want. We talked about vesting last month. That's the idea that the founders get into a company and they are expected to earn into their shares. And by earn into it, what I mean is that they vest. In other words, if you have a 3-year vesting on your shares, you work for 1 year, then you quit, you keep a third of your shares, and you sell the other 2/3 of your shares back at your purchase price, which is probably nominal. So and usually vesting has a 1-year cliff and then monthly after that. For founders, I usually start with 3-year vesting. Just keep in mind that there was a time that people would vest once and that they'd be done. Because they would IPO within the 3 to 5 years of the vesting period or exit in that time. Doesn't quite work that way anymore. It takes a long time to go public. It takes a while to exit these days. And a fund life could be 10 years. So everybody, you should just expect that you're going to be subject to unvesting once the venture capitalists come in, because they need to keep you around. Once they put their money in your company, they need golden handcuffs. They need a way to ensure that you're going to stay there. And if you're fully vested, well, you could leave and keep all your shares. So what's in it for them, right? So VCs are going to require you to unvest or revest your shares. And you should just expect that it could be 8 years that you're subject to vesting. So the other thing that you might see in term sheets is option exercise periods, because lately in the last few years, companies in particular have been saying, I like having options, but I don't like having only 30 days or 90 days to exercise the option when I leave. So company, would you give me a break and give me a year to exercise after I leave, or maybe 2 years afterwards? Just keep in mind, more and more companies are doing that. It's a negative thing from a VC standpoint, because that's more potential dilution for them and for you for that matter. I tend to discourage it, but we still see it. There's something else that you'll see that will probably go away in your term sheet. A lot of companies, when they set up their capital structure early on, they'll create a special class of common stock that has super voting rights. Here's some companies that have done this that you might have heard of: Facebook, Google, and Snap. Just keep in mind that VCs voting rights are going to be super important. They're going to be strategizing and figuring out who can take what actions and who can block what actions. And if you have one founder that has super voting rights that can do whatever they want, you're going to have the problem with that when you get to the institutional round. So just be prepared to have to give that up. I see that given away regularly. Some other terms that you might think about: transfer restrictions generally. So the first one is the right of first refusal. Let's talk about this a little bit, because this has become so much more important these days than it used to be in the old days, because of the secondary markets that have evolved around private companies. So a right of first refusal is a right by the company to purchase somebody's shares before they can sell them to somebody else, right? So I'm a founder and I want to take some money off the table before the company exits, because it takes forever these days, right? So I go find my buddy down the street who's willing to buy my shares, and I say, yeah, I'll sell you my shares, but I have this obligation to offer them back to the company first. So you go offer them to the company. Once the investors are involved, they're going to say, well, not only that, but I, the investor, want to have the right to buy those shares first at the same price you were going to sell to your buddy down the street. That's a right of first refusal. You'll see that in every venture deal. You'll see it before the venture deal, hopefully, because you really want to restrict who can own your shares. You don't want competitors owning shares in your company. You as a founder probably want to negotiate a carve out to that if you can. You want to be able to transfer to your family, of course, to your trust for estate planning. Importantly, you would like to have maybe you carve out 5% that you can sell to anybody with. It's not subject to the right of first refusal, so you can get a little cash out of the deal, because again, it takes a long time these days to get to an exit. And again, if you have questions, go ahead and put it in the Q&A box, and I'll get to them at the end of the presentation. A lockup, that's something that the founders are expected, the common stockholders are expected to sign up to, I guess, for the benefit of the investment bankers down the road if you go public. That is an agreement not to sell shares into the public market after an IPO for at least 6 months usually. So the investment bankers get to go dump their shares, but you don't get to. So go figure, but that's just standard, always has been. Your investors will never agree to that, by the way. VCs are more sophisticated than that. They understand how the process works, but you can expect all the common to have to agree to it. Co-sale rights, that is a right to participate in a sale. So if you, the founder, find someone to buy your shares, remember the right of first refusal, this is the flip side of that. Let's say VC says, yeah, I don't want to exercise my right of first refusal. I don't want to buy your shares. As a matter of fact, I want to sell some of mine. So the co-sale rights means that they have a right to participate in that sale by selling shares to you that you have to turn around and sell to the new investor. A drag along means that this is the other side of transfer restrictions. Drag along means that if the investor finds a buyer for their shares and they're ready to exit. Remember, these funds have a shelf life. They're going to expire. So at some point, the VC needs to exit, and you might not want to. So they'll exercise their drag along. The drag along means when they want to sell, they found a buyer, they can force you, the founder, to sell on the same terms. You'll see drag alongs in every deal these days as well. But although rarely have I seen one exercised, because the founder doesn't want to go along with the deal, there's no deal, right? There's just not. So, but we still see it. I think we mostly view it as a way for somebody to waive their appraisal rights. But that's another topic for another day. Buy-sell, we don't see buy-sell agreements in venture deals, but sometimes people will put in something like buy-sell. What is a buy-sell? What that means is that if a founder leaves the company, remember, he loses his unvested shares. He or she loses his or her unvested shares. What about the vested shares? Buy-sell means the company can buy those back at fair market value. Just don't see that anymore in venture deals. Never did, really. And closely held, you do. But in venture, no. And the reason why is because we all know that the real value in this company is not going to be realized for a long time. So whatever fair market value you come up with early under a buy-sell is not going to fairly compensate the exiting founder. So they tend to hang in there. Rule 144 is a securities-related exemption that requires people to hold their shares for 6 months or a year before they can do a distribution into the market. You usually have to get a legal opinion if you want to sell free of 144 restrictions. And by the way, all of that comes up most often in these secondary sales because, like I say, founders have to stay in there for a long time. So you'll go to a secondary fund and say, hey, buy my shares, and I'll get the company to waive all of these rights. They'll waive the right of first refusal, they'll waive all this stuff. I'll give them a 144 legal opinion, and we're good, and we'll sell. And that's how it usually happens. There are more sophisticated strategies, by the way, with options. So just keep in mind, and also with futures and forwards, securities issues all over the place, but people can monetize their options, even though options are technically non-transferable. Topic for another day. So your cap table, by the time you get to the VC, it's going to have, by the time you're done with them anyway, you're going to have common stock for sure. You probably have an option plan. Your VC wants you to have that. You may have warrants that you've given to lenders and other folks. You've probably sold convertibles, safes, and convertible notes. to your earlier investors, your angels. And of course, the VC is going to want preferred stock and nothing but preferred stock. So what I like to do is I like to back, when I figure out how much the VC should get at the company or what I want the company to look like, I like to back into it and say, I'm happy, and this is just a back of the envelope example, happy giving up control by the end of my Series B round, because at that point, this company is off and running and it's going to be a huge success. If you get the Series B, you should feel pretty good about it. You've had a lot of smart people place big bets on your company. So that's where I expect we would end up at the end of Series B. I think our stock pool is going to have at least 15%. I think the A and B are both going to take around a quarter of the company. That'll leave me with less than control of me, meaning, and by me, I mean the common stockholders generally, and we can live with that at that point. Can't live with that at seed stage. I can't live with that at Series A stage. I want to have majority ownership at Series A stage. And if we just do the numbers, if you back out the Series B, you'll find that this math all changes and the founders' shares go up to above 50%. In the Series A, it would be more like 30 or 40%. And that's how you decide how much you want to sell in Series A. That's kind of my rough way of doing it. Okay, other issues. Diligence. So we should keep in mind that the VC is going to diligence your company. And this is something that you should be thinking about from the moment you form your company. So I've gotten into the practice of advising my clients to start a data room immediately, organize that data room. Don't be scrambling at the last minute. Use checklists that go through all of this. Make sure that your IP is secure. You've got all your invention assignments. Invention assignments might be the most common, gotcha that I see in these deals. We see companies running around trying to get their invention assignments in place at the last minute. Data security is now a big issue. Make sure you've got a good trade secret policy. Make sure you've got good secure processes, two-factor authentication, all that stuff, and really good solid NDAs. And you want a good review of your licenses. If you're a tech company, like most of my clients, technology is your core asset. So you want to make sure that you haven't given that asset away in some goofy license. Employment claims, I won't spend a lot of time on this. Just understand that it's just become a big due diligence issue for startups because everybody messes this up. And some places, notably the state of California, have gotten really tough on this. Taxes, regulatory, litigation, all the stuff you might expect. Just make sure your company is in good shape for due diligence. Entrenched management means let's make sure that you've got vesting restrictions in place like you ought to have. If you don't have them, you're going to have them by the end of the venture capital investment round. Okay, let's talk a little bit about the term sheet, about some of the terms. Valuation is not your biggest issue. Okay, just keep that in mind. I know everybody starts with that, but it's not your biggest issue. There are other terms in here that could gut that big valuation you've been promised right away. Let's talk about what they are. Participation. Participation means the right of the preferred stock to share in the proceeds pro rata of a sale. So the way preferred stock works is it usually gets its money back first before the common stock gets anything. If I'm a VC, I put $1 million in your company. You sell the company for $1 million, I get my $1 million back. I don't get 10% of the company. But participation means I get the $1 million either plus 10% if it's participating, or if it's not participating, I either get my $1 million or 10%. Almost always these days. Series A preferred stock, even later series, almost always preferred stock is what we call 1x non-participating convertible preferred. What that means is that the investor on the sale of a company is going to have a choice. They're going to get the greater of the amount of their investment or their pro rata share of the proceeds based on their percentage. If there is participation, if they do get to get their money back plus a portion of the company, like I get my $1 million plus 10%, that'll always be capped at some multiple. Those are just current terms. And of course, preferred can always convert to common stock whenever it wants to. Maybe next month we'll talk about what that means and why you would want to do that. The preferred will have a dividend preference. What that means is that before dividends get paid to any common stock, the preferred have to be paid their dividends. This is one of the more meaningless terms that you'll see in a venture term sheet because startups don't pay dividends. If they're paying dividends, they're in a position to pay dividends. They're not a good candidate for venture capital. It means they got too much cash and should just go borrow money. But nevertheless, you see it in term sheets that dividends when, and by the way, they're non-cumulative always in venture deals, almost always, which means that it's paid only when, as, and if declared. Cumulative dividend means that it doesn't get paid 1 year, it accumulates. You will see that in every private equity deal. You'll rarely see that in a venture deal. Again, because we're not looking for the dividend. So the preference, we talked about the preference, and let me give you a better example, because this is the guts of preferred stock. As I said, 1x non-participating preferred, we have $1 million invested for 10%, we have a sale of the company for $5 million. Well, how much is that? How much is the investor going to get? Well, 1x non-participating preferred, that means they're going to take the greater of their million or 10%. That's 500,000 is their 10%, but $1 million is their money back. They'll take the million. The other hand, if you have a sale for $20 million, well, I'm going to take my 10%. That's the 2 million, not the preference, which is 1 million. There's a good example for you. Board representation. I really like to see a 3-member board at Series A. Smaller is better, especially in these days, you know, when people do this by Zoom calls on those rare occasions when Zoom works perfectly. So 3 members is good. A founder-friendly board means that the founder controls the board, basically. You got 3 seats, the VC has got 1, and that the founder has 1 seat, VC has 1 seat, and that third person is somebody who's friendly to the founder. You can see how much trouble companies can get into over board representation. Observers. So sometimes you've only got 3 seats. You don't want to increase the size of the board, but you got a party round or something. You've got more than 1 VC, more than 1 person wants a seat at the table. So you'll let them sit in on the board meetings as an observer. They don't vote, but they get to weigh in and talk as much as they want to. Be prepared to indemnify and insure. That means D&O insurance. There's not a VC in the world in their right mind who would invest in a startup without getting insurance in case one of your crazy angel investors decides to sue everybody. So expect that to happen. And by the way, if that does happen, you, the company, have to cover that cost. And we talked about that. Protective provisions. I'm only going to mention, there's a lot of them, but what that means, well, here they are. You can take a look at this list at your leisure, but VCs want to have veto rights. That's what a protective provision is. Can't sell a company without my consent. You can't sell any preferred stock that's better than mine without my consent. You can't redeem, you can't pay dividends. These are standard on the left-hand side. On the right-hand side are some that are not quite standard. I want to pause on this one provision that you're going to see a lot. And people often ask, why Delaware? You know, why can't we have a California corporation? Why do we have to have a Delaware corporation? And there's lots of good reasons for that. You know, our Secretary of State's office is a mess, takes forever. We don't have good fiduciary protection here. We have activist courts. All of that's true. But the number one big reason is that in Delaware, unlike California, we can abrogate class vote. We can make decisions, big decisions, sale of the company decisions based on majority vote. So in other words, in California, if you have common and preferred and you want to sell the company, common has to agree to it and preferred have to agree to it. Well, we don't have that problem in Delaware. We can just put in our charter or organizational documents that they all vote as one big class. That is the number one reason that VCs insist on Delaware. You know, we are at the end of our time here, and there are a couple other, let me just spend a couple minutes. Protective provisions we talked about. Be prepared to get audited. Once you take venture capital money, they're expensive and they're necessary and they're painful the first time around. but you're going to have to give financial statements to your investor and they want them to be audited. Registration rights is the right to require the company to list shares publicly so the investor can sell them. They always have them. I've never once in 40 years of law practice seen anybody exercise them, but they're always there. We talked about the restrictions. We talked about vesting. We didn't talk about pro rata rights, so I'm going to end on that before I get to the questions. But the pro rata right is really a right by, and by the way, safe investors ask for this also. Angel investors ask for this. And it's a right by major investors, not every little dog and cat in the deal, but major investors will have the right to maintain their percentage interest if you do another round. They have a right to put more money into the company. So if they're at 5% of your company before the Series B, and they're a major investor, they have a right to stay at that 5% in the next round. That's a right to maintain their percentage or a right to participate. That can be structured in various ways, but that's generally how it works. It gets really complicated when safe holders ask for pro rata rights, but it can be done, and it oftentimes is done. All right. I know I said I was going to end, but I want to say a couple other things. The option plan, this is a little tricky, so you should know about this. The investor is going to want your option plan to be at a certain level, certain percent of the company, because you need options to go out and hire all the people that you're going to hire with the venture capitalist money, right? So just expect to have to increase that option plan. Now think about this for a minute. If you take the investor's money and then you go increase your option pool, that dilutes everybody, including the investors, because now there's more fully diluted shares out there. If, on the other hand, you increase that option pool before the closing, only you, the founders, get diluted, because the investors, is basically investing on a post-money basis, the VC investor. So they will always ask you to increase that option plan pre-money. In other words, increase the option plan, before we put our money in, or at least increase it in a way that you take the dilution, the founders, and we, the investors, don't. Just keep that in mind. So there's very few games you can play with option plans prior to an investment. Some people say, can I have a really small option plan and increase it after the VCs come in so they dilute along with me? So yeah, you can try, but they're not going to let you get away with that. This other stuff we talked about. Redemption rights, it's a right that the VC has to force the company to buy their shares. Rarely see that anymore. It's just that kind of market. Anti-dilution is the right of the VC. So if you go out, if you sell a VC your shares at a certain valuation, and then in the next round you sell at a lower valuation, the VC gets partial benefit for that, depending on which formula you use. In other words, they're going to get, it's going to be an adjustment in their conversion rate of their shares to common that gives them a higher percentage, so they don't get too beat up by the anti-dilution. And just expect to sign a no-shop once you sign up to a VC, 30 to 60 days. That means you can't go talk to anybody else once you sign a term sheet. And other than that, your term sheet is going to be non-binding except for the no-shop and confidentiality. But be careful. Is it really non-binding? Especially if you're in a state like California, where a court might find that, oh, you really meant a lot of this to be binding, or at least you meant to agree to negotiate in good faith to come to binding terms. So don't plan on that too much. Okay, I'm going to end there and go to questions. And I might come back to this slide set later. But for now, let me go back to slide number 1. And I will open it up for questions. Wow, we went through a lot of slides today. I know I talked fast. You'll be getting a copy of the slide set after this by email. So let's take a look at our questions. Okay, yes, I'm going to send the recorded material for both lectures. You'll find them, tell you what, you will find them both on my, let me go into the chat. You'll find all the recordings. Well, I will send you a link. I can't put it in the chat today, but I'll send you a link and you'll find all of my recordings on the on my YouTube channel. but I'll also send you a link to it. Okay, let's see. Can you elaborate on dry powder? How do you get decision makers when it's the associates that screen you? Okay, two good questions. And I'm glad you asked. So by dry powder, what I mean by dry powder is how much capital does that VC have to call and to invest in later rounds? So you're doing your Series A with the venture capitalist, right? And your Series A is going to get you so far. And then you're going to have to go out and do a Series B. So you're going to have to go out into the market. Well, is your VC going to be able to support you and put some money into that Series B round? Because it's sort of a bad sign to the market if your Series A investor won't invest in your Series B. So ideally, you'd like to have a VC that's early in their life and has a lot of extra cash sitting around or waiting to be called, that they can invest in your Series B round. That's what I mean by dry powder. And your second part of the question was how to get to decision makers when it's the associates that screen you. Yeah, I've got a slide in here somewhere about that, and you'll get a copy of it. But VCs are very, what's the word, stratified or bureaucratic, and you go through different levels. You go all the way from partners down to interns, I suppose. And the important thing is to know who you're dealing with and just try to keep moving up that chain and try to get, because people are screening you and you're kind of pushing you up the chain. And you really, ideally, you want to be in a place where you're talking to someone who can make that decision or who can at least take it to their partner meeting if it's that type of organization. So the best way to get to them is that's who you talk to from the start. Okay, let's see. Is a CPA necessary or required when it's early stage, raising the first round of pre-seed or angel money? Well, it depends what you mean by required or necessary. Your angels are not typically going to require audited statements, so it's not required or necessary in terms of auditing your financials. They typically won't ask for that. They're not all that, honestly, they're not all that concerned with your balance sheet or your income statement. They're more angels anyway, are more concerned with your future prospects. Now they're going to want to know at some point that that you're not doing something that is way off the charts, that you're not booking revenue that you haven't earned, for example. But so for financial accounting purposes, you probably won't need audits, and they might be a little more laissez-faire or lax about your financials, but the smarter angels will still do due diligence and ask you about some of the numbers, like sales in particular, and where is that money going? It's not paying for your boat, is it? That all changes when you get to venture, though. I mean, they have investors they have to account to. Oftentimes, those are institutional investors who are pretty demanding, and they really are going to want to watch every nickel you spend. And they're going to want to know that you're not booking revenue that you shouldn't be booking, for example, and you're not, paying your brother-in-law a big bonus with their money and stuff like that. So for them, they're definitely going to want to see GAAP, what we call them GAAP financials. That's generally accepted accounting principles. Now, even though I've said that, I've seen venture finance companies that don't have GAAP financials. I guess in the smaller rounds, I guess they get away with it if it's the right company. But my experience is we see audits come up in venture rounds. Now, that's the financial accounting side. The other side of this is the tax side. And I'm also a CPA, even though I only practice as a lawyer and I'm only non-attest, they call that tax only. So I can tell you that you want your tax returns to be right. You want to make sure that you don't have some big, huge tax liability. And if we have more time to go through due diligence, we could talk about where that usually comes up in a venture round. But one of the big places, it's not so much income tax because you're a startup, you're not making any money, you don't owe any taxes anyway. However, you could have been entitled to employment tax credits if you'd had a CPA do your return. Alternatively, who knows, you might have messed up your employment tax reporting. You might have misclassified some of your people as contractors when they should be employees. You know, a good accountant will catch this stuff. So it's really good if you can have that. The other area this comes up probably most often is in state tax, because so many companies over the last few years, states have become very aggressive about taxing out-of-state companies. They have what they call economic nexus now. If you do $100,000 worth of business sales in South Dakota, you got nexus there for sales tax purposes. So we're seeing California, it's 500,000. So we're seeing states get very aggressive, and that means a lot of companies have a taxable presence in states that they had no idea that they did. Good accountant will catch all that stuff. And if they don't, someone will catch it in due diligence, maybe not in your A round, but eventually, definitely by the time you exit. So I like to get good advisors on board early on and just make sure things are right and avoid, because mistakes are free when you're a young company. Right? Mistakes are free. They're not free once you become a mature company. They cost you. They cost you in valuation points, or they cost you in crater deals. So yeah, I understand what you're saying, but you know, be careful. It's a risky strategy. Okay, here's a question about vesting. We have a solo founder where VCs generally accept a single trigger upon termination without cause and resignation with good cause if the solo founder is prepared to offer a longer vesting period, such as 6 years. I doubt it, to tell you the truth. I mean, I once in a great while, I'll see single triggers. Okay, let's talk about terms for a second. So what we mean by single trigger, go back, remember what I said about vesting. That's the idea that you earn into your shares as you provide services to the company. So we have 3-year vesting, and you terminate after a year, you keep a third of your shares, give up the other 2/3. Triggers mean that if something happens during that vesting period, you get full vesting. So you own all of your shares, they can't be taken away from you. And that's something that happens are usually 2 things. One is the sale of the company, right? So your company gets sold. It's a stock for stock deal with Microsoft or somebody. If you have a trigger, in other words, change of control, accelerated vesting, that means all of your shares are vested in those Microsoft shares you got in that change of control. Second trigger is usually termination without cause, or as you say, resignation with good reason, usually how it's phrased. And what that means is that, look, if you guys, there's 3 of us founders, the 2 of you might gang up on me, you might kick me out through no fault of my own. If that happens, you shouldn't be able to take my unvested shares back. That's vesting on termination without cause. Now, if it's my fault, if I'm doing something bad, if I'm embezzling or I get convicted of a felony involving dishonesty or something like that, and you fire me, I understand that. That's a termination for cause. But if I get terminated without cause, no good reason, then I should get full vesting. That's vesting on termination. Now, if both of those things have to happen, that's a double trigger. If only one of those things has to happen to get accelerated vesting, that's a single trigger. So in the example in the question, it is, I'd like a single trigger on termination without cause. As I said, rarely do I see that slip through the net. You know, it's just really kind of guts the provision from the VC standpoint, because what they're thinking is that, no, this, you know, we need you to stay. This isn't a mechanism to, you know, make sure you're a good boy and you don't commit crimes and don't, you know, give us cause. It's a mechanism to keep you to stay in this company and make sure it's successful. Because if you leave for whatever reason, we have to go out and find somebody else to take your place, and we're going to need your shares back to do that, rather than have to go dilute ourselves by issuing additional shares. So that's why VC would push back really hard on that. It helps if you have a longer vesting period, but I doubt you're going to get, you know, that's going to work. Because as a practical matter, you're going to be giving up that extra vesting anyway by the time you exit, depending where you are in your company's life. By the way, on a double trigger, the reason you will oftentimes see that for senior level executives, not rank and file, is because it sort of makes sense. Like if you, the founder, have gotten the company to an exit, you've done your job. And yes, the acquiring company, they need golden handcuffs, so they have to keep you around. So they want to see vesting on your shares. Say it's a stock for stock deal or a merger. So, and if they can't, if you're fully vested, then they're probably going to have to give you a bunch of other shares that are unvested to keep you engaged in the acquiring company during the transition period or longer. And where are those new shares going to come from? They're going to come out of the hide of everybody else, including the investors. On the other hand, if look, we've had that change of control, and then the acquiring company fires me because I'm the CFO and they've already got a CFO, well, that kind of cuts against the whole rationale, doesn't it? They didn't really need me, right? So they don't have to give me new shares or anything like that. So that's a double trigger. You get fired, because you're redundant, basically, because you've been acquired and the acquirer doesn't want you, so we should fully vest you. Makes sense. We see that a lot. All right, will VCs be okay with accepting ROFR provisions themselves or include ROFR in bylaws so it's universally for all? I can't say I've never seen that. I have seen that. In fact, I'm working on a deal right now at this moment where I've got that, and the investors, believe it or not, agreed to it, but they were not VCs. I do not think a VC will agree to that. The reason why is they really need to, smaller funds will, larger funds won't, is kind of how I look at it. For sure, and if they do agree to it, when I have seen that, there's carve-outs for when they want to distribute the shares up to their fund, the members of their fund, or stuff like that. So pretty broad carve-outs. So the answer is yes, you'll see that in smaller funds subject to the big carve-outs, but I don't think so in the bigger funds in the later stages. Oh, by the way, this thing about putting the ROFR in the bylaws. So there's a case that in Delaware that came out last year that basically reaffirmed the principle that basically if you're an investor in a company, you're stuck with whatever's in those bylaws. It's like a contract. You sign up to the company, you sign up to the bylaws. So now people are stuffing all sorts of stuff in bylaws, like ROFRs. And we're going to see that more and more. I've sort of resisted that. I feel like that's something people ought to, they really ought to know about, they ought to sign up to, especially here in California. But it's a trend you're going to see more and more. If you do it that way, and I have done it that way, just make sure they're there. Because sometimes people, they skim over the bylaws, they forget that there's these sorts of provisions. They invest in a company not realizing they signed up for a more restrictive ROFR than they thought they were getting. So just know it's there, is all I would say. Can you talk a little bit about what are the due diligence items for a pre-seed fundraising, pre-revenue, small founding team? Well, if you're pre-revenue, that takes a big chunk off the table, doesn't it? We don't have to figure out if, how any quality of earnings analysis or anything like that. You don't have any earnings. What you do have probably are three things. Number one is technology, right? So we really need to drill down on that and make sure that your technology is owned by you. And there's a couple pieces to that. Number one, patent strategy. Do you have patents? Should you have patents? Are they solid patents? And are they patents for all the stuff that you need to have patented? Secondly is trade secret. And this is the biggest one for my clients, even my tech companies. Trade secret is the biggest one because you may have patents, but you got systems and processes and designs, and customer lists and customer data and specs and all the stuff around it that make those patents valuable. So have we gone to the right lengths to protect our trade secrets? Meaning, do we have good solid NDAs in place or confidential information agreements and invention assignments? Do we have good data security? Do we have a good trade secret policy in place so we know that people are not able to easily access our trade secrets? By the way, speaking of cases in Delaware, there was another one 2 years ago now, it's during COVID, where a company lost its trade secret protection because it was doing a lot of its investor calls on Zoom, but they were public and anybody could join, and they were talking about their trade secret. And word got out and they lost their protection, because in order to be a trade secret, you remember from last month, has to be three things. Has to be valuable. The information has to be valuable, has to be secret. And the third one, you, the company, have to take reasonable measures to protect it. So an investor is going to want to know that you've done that, because it's, if you lose your trade secret, you might not have a company anymore. And the third one is trademark. Is your trademark valuable? If it is, have you secured it, your mark and your logo? Have you done everything you need to do to make sure you have rights to it? You're not going to get a cease and desist letter. Then other than IP, the other big category, I think people should be more concerned about, but they're not. I said three things. Number two is employment, because especially if you're operating here in California, and I know less of you are these days, we lost population last year, but if you are still hanging in there, if you're one of the brave few, just keep in mind you're subject, to some very tough rules about misclassification. And if you get them wrong, it is a life-ending event. It's a real disaster. It can be. Shouldn't say it is. It can be for a company because of the way the California employment laws work. There's a Private Attorney General's Act. There are class action lawsuits. There are huge penalties. There are attorney's fees. There are waiting time penalties. There's big tax penalties. So that's one that could be a death knell. And I've seen it kill companies, more than one. And that brings me into the third one that I think a lot about is taxes. And we talked enough about this, is that I think companies get taxes wrong. One thing I didn't mention that I'll drill down a little bit more. So if you're pre-revenue and you got expenses, you might have net operating losses. You're going to lose those at some point in the financing, meaning you won't, after the financing, if you have what they call a change of control, you won't be able to use those losses to offset future income. Just not much we can do about it, but you need to know about it because you don't want to represent to the investor that, don't worry, we won't pay taxes for years because we got all these NOLs. Yeah, well, you used to have them until you did the financing because of the way those rules work. And then I'll say one other one. This is probably the biggest one. Should have led with this. Is the thing we've been talking most about is what's the relationship? What's the cap table? What's your cap table look like? Is it a mess? You have a bunch of unaccredited investors on it. You have people on the cap table who are going to sue me. Are the founders sufficiently locked up? Do you have vesting restrictions in place? That's probably the biggest one, is the cap table. You just need to have that really secure. Nothing kills a company faster or quicker or more certainly than a founder dispute. Nothing I've talked about beats a founder dispute for being a startup killer. So, having a good solid cap table is really important. Okay. How to find out how much dry powder of the VC? Well, you might ask them, and they should tell you. They're asking you questions. You can ask them. I wouldn't lead with that if I were you. But if you get serious and down the road with them, just say, look, you're going to be around for our Series B. Okay, here is somebody who is working for a multimedia company. Okay, we're stumbling when it comes to convincing VCs to invest. We're hard hit by COVID. Who hasn't been? How should we be presenting ourselves to VCs to increase our chances at success? We've built a big company of participants. They're not in the US, we're in Europe. And it's it's an online, it's an edtech or a fitness tech company, it looks like. I get it. Okay, got it. So here's the scenario. We have a non-US company. They've got a big community. They've got a lot of eyeballs. We can count that as traction. They have an online course that they're providing. And COVID hurt because the restrictions really hurt what they could do. And now they're starting to come back. And how do we present ourselves to VCs to increase our chances at success? Well, just follow my formula. Number one, find the VCs that invest in what you do or are interested in you. And by that, I mean both stage. You want the ones that are, sounds like you're pretty early, so early stage VCs, maybe even angels and angel funds. You might even start there if you don't have revenue, because VCs would like to see that. Not necessary, but they'd like to. What they really want to see is traction. So the users is good, but I don't know that you've got enough of them to attract a lot of VCs. So anyway, find someone who's at your stage. Secondly, someone that's in your sector, right? So you just, and it's easy. You go on their websites and you'll see what they've invested in. And I think I'd avoid finding a VC that's invested in a direct competitor, because they might not want to invest in another company if they've already placed a bet. But you could find someone who invests generally in that sector, right? And that increases your chances of success. And then thirdly, and we talked a lot about this last month, and the reporting is available on my YouTube page, but you might say, find some founders that you know that have gotten venture capital investment and ask for an introduction. That is the number one best way, because then you've got somebody vouching for you. But once you get that meeting, the way I would present this is as a, I think is just an opportunity that is within their wheelhouse, that has a very solid team. Make sure you've got a solid team. I'm hoping that you've got good domain expertise, both on the technical side as well as the actual product that you're delivering. And I would start, we talked about this last month, I would start with an executive summary, just get right to the heart of it, stress your strong points, but no better time to get funded. By the way, there was an article just today in the Wall Street Journal that says that venture funding is cooling and companies are being subject to more restrictions and are being asked to show revenue, and are being asked to pinch pennies and generate sales. Budgets are being slashed. So companies are getting more frugal as a response, I think, to inflationary pressure. So just keep that in mind. You know, we're in a good time right now, but that worm could turn anytime, because that's a bad sign. That's a canary in the coal mine when VCs are starting to, you know, tell their companies don't spend so much money, because the inference is you can't count on us for the next round. So anyway, I'll tweet about it later, but Wall Street Journal today. When working with multiple investors, who prepares the term sheets? The founders or the investors? Are the terms same for all or investors, or can they be different? Okay, good question. If you're talking to angels and pre-seed, you might not even have a term sheet because you're selling the safes. But you, the company, will tell the angel what the terms are of your safe because they're so simple. Sometimes we put it in the term sheet if they want to start adding bells and whistles like rights to maintain or pro rata rights or board rights or inspection information. But otherwise, there's only two things you tell them: your discount rate and your valuation cap, right? And the discount rate's usually going to be 20%, and your valuation cap, well, it could be a lot of different things depending who you're talking to. That leads you into the second question. Are they the same for all investors? No, they're not. They can be different if it's a safe for anybody you talk to. Now that's way different than when you get to the institutional round. With the institutional round, the VC is going to give you a term sheet. Once in a while, they'll ask you to propose some terms, rarely. Usually they give you a term sheet. Hopefully you get more than one. And that will be the same for all investors because that's going to be a round, right? And that round is going to have a maximum number of shares that are going to be sold at a certain price. And in fact, that lead investor is going to tell you who can buy shares in that round. I know this because they will oftentimes tell you your lawyer can't have any shares in this round. His money's no good here. That happens. That's when you know it's a really hot company. So yeah, so that's a way different scenario. So angels, pre-seed, it's way different than venture capital. Can you talk about the data room? Who's expected to include by the investors? You know, that's all over the place. You can, I just think a company should set that up. So an investor comes in, you just give them a link and here's everything you need to see. Don't bother sending me your due diligence list. We've already got this nailed. It also makes it easy for everybody to be looking at all the same stuff at the same time. I recommend an online commercial cap table tool. So you could just give someone access to the cap table easily when you need to. There are several online. Email me if you want to know of them. On the other hand, sometimes companies don't have that, or even if they do, the investor has their own data room. In fact, usually they do, the bigger ones, and they want stuff on their platform. But it's a lot easier just to move stuff from your platform to their platform once you've got it all nice and organized in a data room. The biggest reason I like the data room is it just keeps us all organized in the meantime before we even get to the venture capital round. I'm going to go a little late because I started a little late here. Hope you don't mind. Have you seen founders have anti-dilution or other ways they increase their position over time? Rarely. I've seen people ask for stuff like that, but the investors will make it go away. And to me, it doesn't make sense. It's as nonsensical as a post-money safe. In other words, depending on what you mean by anti-dilution. If you mean that they are guaranteed a certain percentage of the company no matter what over time, no, you just wouldn't do that because, right, 20% of a $1 million pie is not the same as 20% of a $10 million pie, right? You should have a smaller percentage of that $10 million pie. If I could do math, I'd tell you what that percentage is, but you get the idea. So I just don't see that if it's there. I have seen people ask for it from time to time. I've seen greedy investors ask for it, and I've seen some desperate founders give that away. But it's really going to come and bite you because that money's coming. That stock is coming right out of the hide of the founder. We're a pre-revenue startup seeking funding of at least $500K. How much equity should I give the first investors? Is it possible to have patent, trademark, trade secret for software business model? Well, if it's 500,000, you're going to give zero equity to your first investors. Instead, you're going to sell them a convertible note or a safe. If you're in Silicon Valley, it's a safe, which means that their 500K will convert into equity in some future round at some maximum valuation. Believe it or not, I'm seeing 8 to 12 million as the range for valuation caps for early stage startups, pre-revenue startups. I also see a lot less. I see people take their first 50, 100 grand at a 4 million valuation because they just need the money to get going. So it's all over the place. But you go out for a big round of safes, you'll see a big number like that. Can you have patent trades? Yes, you can have patent protection for software. It's tricky. You need a patent lawyer for this. You can't patent a business process, but you can patent software if the claims are properly drawn and it manipulates machinery. Can you trademark, trade secret your business model? Trademarks protect. We do a whole session on this, on legal aspects, but generally patents protect ideas. It's a federal registration. Trademarks protect names and logos, fanciful designs. It is also a federal registration, but you get trademark protection by using it first. And trade secret protects information that, remember the three things: it's valuable, it's secret, and you take reasonable steps to keep it secret. And your software and business model will qualify for trade secret protection for sure, possibly patent. All right, last question. If you have an idea while working with a company, how would you approach the company that you're working for? You have an idea. So I think what you're getting at is that you're working for a company and you have an idea. So a couple of things. That idea probably belongs to your employer. And we talked about this last month. And again, take a look at our legal session if you want to hear more about this. But ideas here in California, the rule anyway, in California, the rule is that anything you develop while working for an employer belongs to your employer if it's developed either on the employer's time, with the employer's facility, or if that it relates to the employer's business, right? Or if it's the thing that the employer hired you to do. So the question here, is this something that relates to the employer's business? That's always the question. It's always the tough one. That's always the one we struggle with. If it is, it belongs to the employer. So yeah, you'll have to get a waiver from your employer to go let you do this on nights and weekends. Usually when people start companies, while they got a full-time job as a side hustle, like everybody does, it's because it's something that's unrelated to their current employment. If it's related to their current employment, you have a potential problem. And you may be, doing a lot of work for your current employer without knowing it. Okay, that's it. Thanks for being here. We're going to stop the share at this point. I am going to be sending an email. The recording will be here. Sorry about the technical problems. Some things, believe it or not, in this world are beyond my control. I think I found one of them. I will send you the slides. I will send you a recording. I will send you a copy of my new book, 10,000 Startups, Legal Strategies for Startup Success. And we will see you next time.